bonds and fixed income markets are right at the epicenter of everything that's going on in financial markets at the moment. We've seen some of the most incredible outsized moves, particularly in the UK, but this has all been a long time in the building. So to get a sense of what's going on, I spoke to LSEG's David Rickard, who's a specialist in fixed income and currency markets. Welcome, David. There's a hell of a lot going on in fixed income markets, in fact, fixed income and currency markets. But today I want to concentrate on fixed income because we've seen some phenomenal moves in yields in certain areas, and it's still ongoing as we record this on the Tuesday. So I'd really like to get your view firsthand about why we've seen, or what's been the big driver of these yields really over the last few weeks when we started to see yields really pick up and take off. What's been the background that's been leading up to this move that we've seen in recent weeks?
Yeah, I think that, like you said, Roger, there's a huge amount going on. I mean, it's important to put things in context, right? We came into the beginning of this year with 2-year yields in the major economies, some of them below 1%, 10-year and 30-year yields below 1.5% or 2%. And now we're touching on, between 3.5% to 5% between European, US, the UK yields. And the main factors which have been driving them are kind of similar themes that we've been used to throughout the year, which is mostly inflation. So we came into the year believing that inflation was going to be transitory. Most people were focused on supply side constraints, temporary spike in energy prices, and those forces have persisted. As a result, we've seen the market increasingly respond to that. And I think in the last month and a half in particular, we've seen the market price in more and more from the central banks to tackle this inflationary issue. So rather than believing the previous dogma of lower for longer or a bias towards letting inflation run hot, given how high inflation is continuing to print, there's a recognition now in the market that the central banks have got to do more, have got to go faster, have got to go in bigger clips. You're seeing 75, 100, 125 basis points discussed for different central bank moves. 75 basis points is becoming the new 25 basis point move. So those are some of the factors which have kind of underpinned the recent move. And then I think, you add to that, we're coming off a 30-year plus bull market in bonds. And that's why at times it's getting a little bit messy.
It was sort of a rapid grind higher first, but we've now seen it to turn into a surge. Now, before we get on to certain regional factors here, do you think that the surge is because the market has consistently thought the Fed will pivot and the Fed has actually consistently said, no, we're still going? So effectively, the Fed keeps surprising the market. Is that why we've seen it really shift gears really from what was quite a quick move into something which has become more of a surge in recent weeks?
Yes, I think that expectation component is key, right? It's worth remembering that really markets are not pricing against what rates are today by the central bank or even economic data is today, but where they see it going in the future. And the previous framework that we were working off for the last 30 years was lower for longer, inflation always disappointing on the downside, not on the upside, and central banks always having this freedom to essentially focus on growth or unemployment without worrying too much about inflation. That's clearly changing. We will find out over time and in hindsight for how long it's changed, but the markets can only go so long without recognizing 10% CPI prints. So yes, you're seeing more and more response to that, and also the central banks themselves making a change in their position. Most famously the Fed. Look at how they've changed this year. They've gone from calling inflation transitory, managing the market to be restrained in its interest rate hiking expectations, and now we're talking about 4.5% to 5% rates by the end of the year in the UK and the US. So a big turnaround.
And then geographically, there's been this real spotlight on the UK where we saw this. We're talking about surging, but it sort of went into overdrive, the surge for the UK. What's going on there? Because we saw the big surge. We've seen attempts to stabilise that from the Bank of England, but even then, on I think it was the 10th of October this week, again we saw these 30-year gilt yields going significantly higher. Could you talk through, maybe break down What's actually going on with this UK bond market at the moment?
Yeah, I think there's a number of factors which you kind of have to put in the mix there for the UK. I mean, don't forget we have a significant current account deficit. We have a significant budget deficit. Both those factors mean we rely quite heavily on inflows of capital. On top of that, the gilt market, certainly at the longer end, 10-year and beyond, heavily influenced by domestic pension funds who've been kind of one-way buyers of gilts and linkers or inflation-linked gilts for over 20 years now. And that's the structure of the pension fund industry in the UK, slightly different from other economies. So both of those factors kind of, contributed to a situation where as yields repriced higher, there was some market dysfunction. And why were yields moving higher? Part of it is what we've already discussed about inflation printing higher central bank expectations, but really it was that change in leadership in the Conservative Party with a new Chancellor, a new Prime Minister coming in with a highly stimulative mini budget, as it was called, on the 23rd of September. And from there, it got quite disorderly in the gilt market. So, what we saw over the days after the mini budget and, the comments around further tax cuts was just a extreme market moves in gilts like we've rarely seen. The order of magnitude 1.5, 2 times previous market dysfunction movement. So if we look back to the LTCM crisis in 1998, I think the move over the 4-day period after the mini budget was 1.5 or 2 times the size of that move. So really extreme moves, coupled with a relatively illiquid market, especially at the longer end, because of that supply-demand dynamics. And we can go into that more as well in terms of some of those pension fund players.
And the Bank of England has come in with a stabilisation where they've gone from wanting to do quantitative tightening, so letting bonds roll off or effectively sell them, to going back to effectively queuing and buying bonds. And then this week they've announced that they're going to buy the index-linked bonds as well. So they've basically gone back all in. I mean, is there no way out for the Bank of England in terms of being able to reduce its balance sheet?
Yeah, I think it's important to kind of distinguish between what the Bank of England has done in the last 2 weeks and QE. This is much about market functioning and being a buyer of last resort in what could turn out to be a kind of a fire sale dynamic in gilts and linkers. To put a little bit of background to it, a lot of this is driven by the liability-driven investment funds that are active in pension funds. So pension funds, big buyers of gilts, big buyers of inflation-linked gilts, over the years have progressively used derivatives to manage some of their liabilities, receiving on interest rate swaps or inflation-linked swaps. As yields moved rapidly higher in the days after the mini budget, there was collateral calls on those derivatives. And that was beyond the expectations of many pension funds or these pooled funds that manage pensions on behalf of a number of schemes. And simply put, the money couldn't pass through the system fast enough. And as a result, that put a huge amount of pressure on finding cash quickly. And that was often led to selling more gilts, which was a self-reinforcing cycle. And not just that, but potential defaults on some of these derivative positions would then represent a major loss for banks or big asset managers. And as a result, that would pose a systemic risk to the financial system. So I think the action that the Bank of England took was completely necessary. I think the tricky bit for them will be how to exit that now. It's due to end this Friday. You've seen more news today of them extending the scope of that purchase arrangement to include linkers. Will they be able to end it on Friday and not risk another disorderly move in the gilt market? That's really the question. It seems a lot to expect pension funds to essentially deleverage themselves in the space of 2 weeks. I mean, it's taken 20 years to build into this position with progressively lower yields, kind of prompting that by the pension fund industry. So I find it will be interesting to see whether that can be resolved in the next few days.
And the focus has been on the UK, but what we're seeing here in many ways is it's the UK pensions industry is levered into the sort of the bond matrix, as it were. But leverage is something that everybody's been using over the last 20 years for the same reasons, which is yields have been falling. Is this really an isolated UK case, or is it something which there are issues in US pensions? And when we look at Europe and their energy problems as well, where they're having to do budgets now, the scale of which is similar to what we've seen in the UK. Is this really isolated to the UK, or are we going to see similar issues elsewhere as everyone deals with similar problems of deleveraging and energy crises?
Yeah, I think the risk is we do see it elsewhere. Like you said, the consistent fall in rates for years, decades now has definitely led to extended leverage. We saw massive deleveraging happen after 2008, 2009, but rates have stayed very low since then, with a huge amount of QE pumped into the system. Where that leverage is and who's going to get caught out, that'll be the difficult answers to find over the next few months. We've also seen a massive strength in the dollar recently, order of magnitude 20-25% against multiple currencies, and the Fed seem determined to keep hiking until either something breaks or inflation comes down. Now, with inflation still so high, it's likely that such a tight monetary policy will probably lead to some other market event. It just depends on where it is and how severe it is.
What with these sort of, we're all wondering what this causes in terms of asset prices, because we're seeing people like the Bank of England now potentially locking back-end yields or holding them up, but at the same time fighting inflation by raising rates. Are we going to see incredible distortions in yield curves? And then secondly, it seems that those countries which are having to do this, Japan, the UK, Europe, all seeing their currencies getting hit as well and going down. So as you said, the dollar's going up. What are the implications for things like yield curves and currencies of this sort of action?
Yeah, I think we're seeing previews of it in the UK, in the sense that a real weakness in the currency against. We mentioned those deficits earlier: the budget deficit, the trade deficit, and forcing the hand of the central bank to, on the one hand, raise rates, but on the other hand, not trigger some sort of financial crisis or meltdown with a disorderly move in rates. So the Bank of England are certainly trying to juggle that at the moment by managing long-term rates and at the same time raising short-term rates. It'll be interesting to see how the Fed and the ECB, in particular the ECB, has got a huge balance sheet. At the moment, they're just discussing how to begin QT. They're still focused on hiking rates, but you would think that they will face a similar challenge over the next few months.
And then I think what people are always looking for, because all this sort of stemmed from the Fed's tightening too fast, the dollar's surging, yields are moving, triggering things. What's it going to take for the Fed to pivot? Because they keep on saying we're keeping on doing this, we're going to maybe cause something to collapse, to tighten conditions, to bring inflation under control. Will they carry on doing this until they bring inflation under control? Or will there be enough pain somewhere for them to maybe step away and say, okay, we've got to let inflation go a bit higher? When do they pivot? What's going to be their driving force?
I think they will keep going until inflation starts to turn lower. I think it'll be difficult for them to do anything different. Unfortunately, they're in a bind right now. They're caught between the data forcing their hand to continue to hike, to continue to manage that restrictive message. We're targeted for rates to get to 4.5%, 5% early next year. But even the Fed themselves acknowledge that they'll probably be cutting rates come 2024, 2025. So there is an expectation growing that something is going to break or slow significantly. But the Fed and other central banks haven't really faced this dilemma in a almost a generation, if you think about it, because they've always had the air cover of lower inflation that has allowed them to back off tightening policy in the past. So this time around, they're under real pressure to keep tightening because inflation remains at these unprecedented levels. And we'll either see inflation moderating perhaps later this year, early next year, or some event will happen similar to some of the episodes we've seen in the UK in the last few weeks that will prompt an easing. But it will have to be something relatively systemic to lead to that outcome, because if you compare it to what's happened in the UK so far, it's reasonably contained. We haven't seen any spillover into the real economy. It will need to be an event big enough to impact the Fed's kind of dual mandate and to really risk the wider issue of financial stability for them to pause.
So just finishing off, if let's say there isn't a systemic risk that the US feels is big enough, so it's all about inflation, are they going to look at things like CPI, or are they going to be looking at wages and employment? Because it seems it's the tight labour market, maybe not strong, but tight labour market, which is creating a reticence for them not to do anything, even though maybe commodity-based inflation has turned around a bit. What should we look at, CPI or things like wages and real wages and stuff like that?
Yeah, I think we should definitely be focused on wages. The Fed's got a dual mandate. We can question how often they adhere to that. But and the second piece of that is price stability. But let's remember that they focus on core PCE, which is a lower figure at the moment than CPI or core CPI. So it's not quite as bad as it appears on the headlines for the Fed in terms of inflation. But they will be looking at that wider picture, particularly the tighter labour market. Will we see signs of that easing over the next few months? That's going to play a key role into the pace and magnitude of the hikes. If you look at what's priced right now, the magnitude and the terminal rate that the Fed are expected to deliver, those are historically tight rates. Before the financial crisis, we were looking at kind of 4, 5, 6% rates as generally perceived as tighter rates. Well, that is what's priced now across the UK and the US, for example. So if we get there by the end of the year, then you would think the Fed has done enough, but we will have to see, where inflation goes in the meantime and the labour market.
Great. Well, thanks very much. I mean, it sounds like this is something which will keep on going well into 2023, but thanks very much for your input. It's one of the most fascinating macro backdrops we've probably ever seen.
Yeah, for sure. Yeah, no, it's great talking to you.
So as you can see, there is a lot going on. It seems that this is going to play out over some time. The focus has been on the UK, but the UK problem is a global problem, not because of the pensions, but because of leverage that has built up over many, many years, in fact, decades, as you heard there. And the problem is that as yields go up, that leverage comes under a lot of pressure. So I think this is going to be very much the weak spot of financial markets and the economy, and it's going to be down to whether the US and the Federal Reserve want to step back before something in the international system breaks. It's almost broken in the UK, but not quite there yet. But these are problems that are going to appear in many other parts of the global economy.